Alrighty, let's talk about a new area called credit losses. And it kind of takes something that we dealt with for a long time, bad debt expense, for example, and we're renaming it to credit losses. And this is an area called current expected credit loss, or CECL. So current expected credit loss, or I'll refer to as CECL. And basically the CECL model is a credit loss accounting standard that was issued by the FASB, and it came about because of the global financial crisis of 2008. 2007, 2008, there was a whole big mess. And what happened is, under the old rules, banks would loan out money. So they go, sure, we'll loan you some money. You need some money? Not a problem. We'll grant everybody credit. So they would loan a lot of money. They would set up an allowance for bad loans or amounts that were not expected to be collected. And they did this when it was probable that a credit loss had been incurred. So under the old rules, they wouldn't allow you to book it until they had occurred. However, banks weren't really forward thinking enough to see that there was an upcoming economic downturn. So what happened is receivables were going up, but the loan loss reserve, or their uncollectible allowance, wasn't increasing at the same rate as their outstanding receivables went up. Because of this, companies like Lehman Brothers went bankrupt. Other companies like Merrill Lynch and AIG, Freddie Mac, Fannie Mae, all of those had to be rescued and bailed out by the government. So losses were recorded too late. So it's kind of like saying a little bit too little too late, huh? Little too late. So now, under the new rules, CECL, which is the current expected credit loss, the banks need to go and they need to estimate the expected credit loss of an instrument over its entire lifetime. So we're looking at the future potential losses. In the olden days, it was just what had occurred or what had been incurred. Now we're saying, okay, let's look ahead and say, oh, here's 100% receivable. We only think 85% may be collected by the end. Therefore, we need to set up that credit loss for the other 15% now, or 15% now. So we're going to set this up when the asset is either acquired or originated. So if I loan you money, that's when it's originated. If I'm purchasing it, and we'll talk about a purchase credit loss later on, if you're purchasing it, then it would be when acquired, even if the risk of loss is remote. Now, in the olden days, we said not if it's remote, only when it's incurred. Now we say even if it's remote, we're still going to recognize it. So now we're going to recognize the credit loss on the assets that don't even have evidence of a credit deterioration. So it hasn't yet deteriorated. We don't know if it's going to deteriorate, but we're going to forecast looking way out into the future. So with CECL, current expected credit loss, it allows better transparency of the credit risk that exists in the bank's assets. It also went in and added many, many more disclosure requirements. So when we talk about disclosing it in the financial statements, whose statements are these? Management's, right? We're going to disclose it here. And it also has more of a forward-looking view of the real or true credit risk. That way, the banks can set aside enough capital to cover the potential future losses. So basically, the bank's going to loan you money. They're going to have a receivable. They're going to book those future estimated losses, and we're going to be booking those now, so our carrying value or amortized cost of the receivable is at a lower amount. So that way our allowance is sufficient enough to cover the losses. So you can think of it this way. In the old rules, it was recorded as incurred. So we recorded the incurred loss in the portfolio. That was called the incurred loss model. Again, it was based on the loss. The new rules under CECL, it records the risk in the portfolio. So that's going to be called the current expected credit loss model. So instead of the incurred loss model, it's the current expected credit loss model. So again, CECL's forward-looking. It considers the entire lifetime of the loan, even if it's remote. It results in earlier recognition, and it also may result in recognition where in the past none of it would have been made. So in other words, we may not have booked a loss in the olden days, where in the new days we will. Since receivables, when we're looking at accounts receivable, notes receivable, long-term receivables as well, such as receivables that are current with respect to their payment terms. So in other words, we may have a receivable where everyone's current with their payment terms. It doesn't look like a problem, but we're having to be forward-looking and say, well, what do we think is going to happen into the future? Now, to calculate the allowance, we can use historical information past, current conditions present, or terms they call reasonable and supportable forecasts. So that's going to be for the future. So again, it's kind of called the predictive model, and we'll look at that a little bit later. So if you come on over here, come on down, we're looking at the current expected credit loss model, or CECL, right? CECL. So that's the current expected credit loss model. We're estimating the expected credit loss over the entire lifetime, and that's whether when you acquire it or when it's originated. Originated, I originate the loan. I acquired it, I went out and purchased it for you. We're going to look at historical information to figure out a valuation allowance, and this is just a quick overview of where we're going to go. We're going to look at current information, but also reasonable and supportable forecast. So looking out into the future, that's what we're going to be looking at to see if in fact it makes sense, if in fact the information is reasonable. All right, now our goal is to book the net amount expected to be collected, the net amount. And we're going to book that on the assets, and we're going to look at the assets that are either measured at amortized cost, which we'll talk about amortized cost, kind of like your carrying value, or some other asset. So for example, we're going to talk about AFS, available for sale debt securities. That's another area where we're going to look at setting up these credit losses, but we're going to talk about that in a different section. We'll talk about that in the investment section. So we're not worried about AFS debt securities today. We're going to be looking at amortized cost first, kind of get the understanding, and then throughout the course, you'll see where we had to make adjustments or updates for this credit loss standard. So for example, I loan you money, or I have an account receivable, and we know we're not going to collect all of it. What they're saying is we're going to hit the credit loss now, right? We're going to expense it now, and we're going to set up an allowance account as well. So basically, the journal entry would be, and I'll put it right here, basically we're going to debit credit loss expense, right? And that's an expense that goes to the income statement, and we're going to credit allowance for credit loss expense, and that goes on the balance sheet. So notice we've got our debit to expense, which goes to the income statement. We've got an allowance. It used to be called like allowance for doubtful accounts for accounts receivable. So allowance for doubtful accounts to get it to the NRV. Now we call it allowance for credit loss expense. It's the allowance. It goes to the balance sheet. It is a contra to the receivable. So if we have a receivable here, some kind of AR, we're setting up an allowance, which is going to be the credit here. That's going to be basically the net value. That's going to be the amortized cost. That's going to be how much we think we're going to get at the time that we're going to collect it. What we used to do is we didn't hit this until it was incurred generally. We do some estimation techniques and hit it. Now what they're saying is look at how much you think you're going to collect at the very end, potential future, reasonable and supportable forecast. Hit that, and then we're going to hit that now. So that's basically what we're talking about. So again, we're hitting this debit to expense. Similar, we're hitting an allowance account. The allowance is basically a contra or a reduction of this, so it's a contra asset or a valuation allowance to the receivable. This could be an account receivable, note receivable, whatever kind of receivable it is. We want to account for that credit loss now. Now the carrying value is measured, as I said, amortized cost using the effective interest rate at inception of the interest at the instrument, and it's reduced by the allowance for credit losses. Now on each reporting date, what we're going to do is we're going to adjust the allowance either up, increasing it. That way it will equal, the net amount equals what management expects to collect. So what we're going to do is every year we're going to say, okay, how much should this be? So let's say this is 100. And this is 5, so the net is 95. Then at the end of the next year, we go, you know what, we have new information, the market's changed, we only think that we're going to collect 25, so 100 minus 25, we think that's going to be 75. Therefore, we need to hit this for another 20, another 20. So basically what we're doing is we set it up at inception, and then we're going to adjust it at every reporting date. So whether it's 12/31 financial statements, we're going to adjust it up or down to adjust it accordingly. If we're going to increase the allowance, then basically it's going to be credit loss expense and your allowance for credit loss. If it's a decrease, let's say now instead of 25, we want to go down to 15, then we flip this, debit allowance for credit loss expense. So we're reducing it by whatever, let's say 10. What that's going to be is a reversal of the credit loss expense. and that would be for 10 as well. So that's called a reversal. We would just be reversing it out. So again, it's a similar concept that's existed since you were an itty bitty kitty in a cribby. What we're doing here is we're just making some adjustments to it so that way the concepts make sense. So the goal on the balance sheet is to reflect the net amount expected to be collected. So we're going to have, let's say, the receivable. So let me clean this up a little bit here. So we have the receivable, let's try it in black, and let's say the receivable is going to be at the amortized cost. Let's have 100. Then we're going to set up the allowance for the credit loss. And let's say the allowance is 15. 100 minus 15, that's 85. So we're going to have it at basically the amount we expect to collect, kind of like your NRV for receivables. So that's what we're looking at as far as how we want it to be on the balance sheet. So we're going to adjust that again. It's basically what some people have said is the amount is the same. It's just the timing of when you're going to book it that is kind of different. All right, so if you look in your notes, you'll see that it applies to a variety of assets, and it applies to a variety of assets that are measured at amortized cost and some other assets. And again, the other assets we'll talk about a little bit later in other sections. Like I said, AFS debt securities available for sale and held to maturity debt securities we'll talk about in the investment section. So in your notes, there are a variety of assets. What are some of the assets? Trade accounts receivable, so that would be a receivable from the normal course of business. Financing receivables, and a financing receivable is basically defined as a contractual right to receive money on demand or on fixed or determinable dates, and which is recognized in the balance sheet. So some financing receivables might be a loan receivable, accounts receivable, notes receivable. So it's any kind of financing receivable that we're acquiring. And remember, we talked about either when it's acquired or when it originated. Held to maturity debt securities, and again in another section we'll talk about trading securities available for sale, held to maturity. So held to maturity debt securities, available for sale debt securities, other assets like a lessor's net investment in the lease. So these other assets, that would be like a receivable. So we have a lease receivable account, and we're looking at this from the lessor standpoint. We'll talk about lessor lessee. This would be like a non-operating lease from a lessor, like a sales type of direct financing lease. So that's what we're looking at from the lessor's standpoint. It might be a financing lease to the lessee, but a non-operating lease to the lessor. So that'll make more sense after covering the lease section. Also, certain things like certain types of guarantees. In the notes, you'll see a list of exclusions, and these are financial assets that are not subject to credit losses. Things like equity securities, right? Stocks. And you may recall earlier, we talked about the fair value model. Well, we're going to measure securities at fair value, right? And changes already go to your income statement. So for example, you buy Apple stock worth $200, $300, $400. I put it in there at fair value, and then I just adjust it. And in the previous section, we talked about the fair value model, fair value measurement. That was over here. That was different ways to measure fair value, what's considered fair value, what isn't. So that was equity securities, for example. Trading debt securities that are also carried at fair value with the changes going into net income. Operating lease receivables, those are things that are not non-operating. So non-operating leases are included. Operating lease receivables are not. And we'll talk about them more in leases. Related party loans or related party receivables, because if they are under a common control of the same company, then that's not included, kind of like a related party transaction. Other types of loans, you'll see them listed in the book. Those are certain things that are excluded. Now, there isn't a specific credit loss estimation method, and that's what's kind of unique. In the olden days, we said, here's the method to use, here's how you're going to calculate it, and so on. Now what they're saying is, look, you use your judgment to determine the most appropriate method for you, for the industry, for the business that you're in. So it could be based on the holdings, whatever that receivable consists of, or some loss experience that you've had in the past. In the past, 3% is usually uncollectible. Maybe that's what I'll use. So whatever best relates to the company, whatever best relates to the asset. Let's say I have a group or a pool of these receivables. Well, there's also a lot of flexibility on how to account for the pool of financial assets. if they share similar risk characteristics. And those risk, and again, that's what we're measuring. Remember in the old days, we measured the loss, now we're measuring the risk. We're saying, what's the future risk? What's going to happen down the road? So risk characteristics can include things like risk ratings, the financial asset types that we're looking at. It could be collateral types, the size, geographical location, the customer types. In other words, I'm making sales. Are they sales to wholesalers? Are they sales to retailers? You know, what kind of client am I selling these things to? What we need to do is we need to pool these together on what we call a collective basis. Then what we're going to do is recheck them each measurement date. If they're not similar, then we can evaluate them on an individual asset basis. But again, we're concerned with what we call the risk characteristic. So that'll tell us how to kind of pool these assets together as to how we should account for them. And then at the end of the year, if that pool has gone up or gone down, then we will set up the allowance again to allow for your credit loss. All right, so again, we hit credit loss expense, allowance for credit loss expense. So again, there's a lot of judgment here in how you're going to do it. There's judgment here in how you're going to pull them together. You're going to do what's best and most fairly states your company's financial statements. Also, as I mentioned earlier, to calculate the actual allowance, it is going, and that's where we're calculating the estimate of expected credit loss. We can use historical information, current conditions, or reasonable and supportable forecasts. Now, if you look over here, what we're looking at, as I mentioned earlier, I'll show you again, we can base it on historical. Again, looking back, we say, well, historically 70, 97% are what we're going to collect. Okay, then that's what I'm going to hit. Current conditions, saying, wow, the economy's kind of sucking lately. Maybe collectability is going to drop because more people are going to go into default. So we're going to, and again, the olden rules, what was incurred, that way it was more conservative in a sense. Well, let's say it was less conservative because we weren't booking enough. And then that's what happened in the 2008 financial crisis. Now they're saying we don't want that. We want to make sure companies have enough of an allowance for bad debts, for credit loss. That way their net carrying amount will be lower. Reasonable and supportable forecasts, again, those are the things that we're looking at. So in doing so, in your notes, you'll see a list of different methods to help calculate that allowance. And there's no one method that you have to use. Like there's one there, the first one mentioned is discounted cash flow method, DCF, discounted cash flow method. And the discounted cash flow method, it says losses are estimated by comparing the asset's amortized cost to the present value of estimated future cash flows. So we're going to look at, okay, what is our amortized cost? What is it in our books for? Versus how much do we think we're going to get? If we think we're going to get less than what we have it in our books for, we better write it down. Now this one's widely used, and a lot of people think, oh, you're required to use present value discounted cash flows. You're not. You don't have to use this. You're going to use whatever is best for your business. Another option is loss rate method, and that's where losses are estimated as a percentage of total exposure. So we'll take our estimated loss rate times the amortized cost. So for example, this might be receivables, and you say, okay, here's total credit sales, not total sales, but credit sales, because if it's a cash sale, what's the probability of collecting it? 100%. If it's a credit sale, well, maybe not. So that's where you say, based on past experience, historical, current, future, I think 15% will not be collected, then let's hit that now. Roll rate method, that's where expected losses are projected using historical trends, and we're looking at the credit quality indicators. So for example, we might be looking back and saying, okay, what are the delinquency rates? Let's take that and kind of roll it forward. Probability of default method, that's where losses are estimated by multiplying the likelihood that an instrument will default by the balance. So that might be a percentage where you say, okay, here's this balance outstanding, here's how much. Here's another balance outstanding, here's how much. Then we have an aging method, which is kind of like what we've used for receivables for years. That's where the impairment is calculated based on how long a receivable has been outstanding. So we might say something like, okay, we have these receivables, let's see how long they've been outstanding, because that might help us to determine the likelihood of collecting it. So if it's 0 to 30 days, 2% is uncollectible. 30 to 60 days, 5% is uncollectible. 60 to 120 days, 10%. And then you'll multiply that times the balance, and that'll give you what your target amount is. That's how much my credit loss balance allowance should be. What do I have? The difference would be the adjustment. So again, we're trying to figure out how much we're going to need in order to account for that difference. Now, the first one I mentioned was the discounted cash flow. When you're using the discounted cash flow method, we're going to look at the expected future cash receipts. And the expected future cash receipts are required to be discounted or present valued using the effective interest rate of the instrument. The valuation account will then equal the difference between the amortized cost, or your book value, and the present value of the future payments expected to be collected. That way, we're going to say, oh, I don't think I'm going to collect as much as it's in my books for. I better set up an allowance account and set up an expense today in order to account for the balance. We're going to do this every reporting period. Now, I talk about present value in the discounted future cash flows and using the effective interest rate, and you're going, what does that mean? Don't worry about it yet, because we're going to hit an area called bonds, not bondage, but bonds, right? The other one might be more fun, but not as practical to become a CPA. Yes, sir, Bob, unless you're watching the show Billions, and there's a lot of stuff going on there. That's another thing. Don't watch TV until after the exam, right? No TV, no social life, no personal life, no fun, nothing until after the exam. Once you pass the exam, send me a case of Mountain Dew. I got to keep this energy going. So in bonds, we're going to learn about discounts, premium, amortization, effective interest method, stated rate, effective rate, market rate, yields, all that stuff. Don't worry about it. So we're kind of sprinkling that knowledge now. We'll get more into it later. You'll see some other issues in your notes. Off-balance sheet risk. Off-balance sheet risk needs to be reported where? In the financial statements. Let's say, for example, I guarantee your obligation, right? So I'm guaranteeing your obligation. So I'm guaranteeing the credit loss of another company, like a guarantor. Well, that's a credit loss that is required to be reported on the company's financial statements in the liability section. So that's kind of an off-balance sheet risk, because I may not owe it if you pay it, but if you don't pay it, I'm going to owe it. We'll set it up as a liability. Credit enhancements, or a letter of credit. That's if you guarantee my debt. Well, it may reduce my exposure to credit losses. It'll affect the estimate of my credit losses if it's not freestanding. So if it's embedded in the financial instrument versus freestanding, don't worry about it at this point. Those are some other off-balance sheet risks that we need to note. There's something called purchased financial assets with credit deterioration. These are called PCD assets. And basically what that is it's called a purchased credit deteriorated asset. And it's basically you're acquiring or buying this asset that has credit risk, right? Because it's deteriorated as far as the likelihood of collecting. So it says in your notes, PCD assets are a new term under ASC 326, which is CECL, current expected credit loss. Basically, when you acquire a financial asset that's experienced more than insignificant deterioration in credit quality. So in other words, it's not just deteriorated, but it is more than an insignificant deterioration in credit quality. You purchase it at a larger discount because of the potential for credit loss. As a result, the discount is based on two risks. So I'm buying this financial asset, a receivable. I'm buying this receivable that has credit deterioration, called a purchased credit deteriorated asset. What happens is it has more deterioration than is considered insignificant. So it has a fair amount. What it says is when I buy it, I'm going to want a discount, right? Because I'm not going to get $100 for the whole asset. I'm going to get less, so maybe I only want to pay $80 for it. So I'm getting some kind of discount of $20. What we need to do is say, okay, what is this discount based on? Because the discount could be based on one of two things. The discount could be based on what we call market risk, or it could be based on what we call credit risk. So it could be market risk or credit risk. That's what that $20 discount is based on. The market risk is the difference between the instrument's stated rate and a comparable market rate. So what happens is, and we'll learn this in bonds, where you've got a stated rate of 8%, but you want to earn 10%. If I want to earn more, you better discount it. So let's say in today's market, I could earn 6% on this bond. Would I like to earn 6%? Yeah, because my money in the bank's earning half, a quarter of 1/10 of 1%. So I go, sure, I want 6%. You go, no, I'm going to charge you a premium because I want to take the 6% down to 4%. Or let's say it's paying 6%, but I could go invest something for 8%. Well, why am I going to buy your stupid 6% when I could earn 8? You better charge me less up front, a discount. And so that's what we're talking. So that's called the market risk. The difference between that is going to be considered an adjustment to the carrying value of the instrument and is amortized under the effective interest method, which affects interest income. So this difference, if it's market risk, affects interest income. So you're going to take that difference and amortize it out as we would with bonds. Again, once I teach you bonds, it'll make more sense. Right now, I'm just trying to get you some theory. The credit risk, this is the risk that the person will not come through. They have bad credit, right? So this is the risk they're not going to come through. They're not going to pay. They have credit risk. So that's going to be the credit risk, which increases my risk for their credit quality, which says that there's a deterioration, I may not collect the money. With credit risk, it is not recognized and amortized in relation to interest expense. Instead, what we're going to do is the initial amount is added to the cost of the investment and accounted for in the same manner as credit loss. So here, this becomes a credit loss. So the two differences here, market risk, credit risk. Market risk says, why am I getting it at a discount, for example? Well, maybe because it's paying 6%, but I could earn 8%, then I'm going to pay you less. That difference would be amortized out as interest income. The other amount is because they're not creditworthy, right? Reminds me of Seinfeld. You're not sponge-worthy, but you're not creditworthy. You're not creditworthy, then what we're going to do is we're going to add that cost to the investment. Right? So instead of just setting it up as an expense, we're going to add it to the investment. And what we're going to do is amortize that out, or we're going to take that out, but we're going to hit it as a credit loss. So at the acquisition, we're going to estimate and record an initial allowance for the credit loss, right? For the credit loss. That's for the credit risk. This amount is then added to the purchase price as opposed to reporting it as a credit loss expense. So when you acquire this asset, for example, okay, so we're buying this PCD asset. All right, so with this PCD asset, what we're doing is we're setting this asset up and we're acquiring this purchased credit deteriorated asset. We're going to debit the asset. We're going to credit your allowance for credit loss and whatever you paid for it. Okay, let's say I paid, here's the 80. Let's say this is 20, and so on. So that's what I would normally do. Now, normally what I would do is hit this for the debit, but I would also hit allowance for, not allowance, I would hit credit loss expense at the time that I buy it. So normally you would have some kind of allowance and credit loss expense. What they're saying is no, don't do that, add it to this price. So you're putting it in there. Then as it changes each year, we're going to do the normal entry for additional credit loss expense or reversal of credit loss expense. So I'll either increase it by debiting expense and credit allowance, or we'll have a recovery and I'll hit allowance and credit recovery. All right, so that's the big difference. So again, for the market risk, that is your interest income. For the credit risk, that's going to be credit loss. But when you acquire the PCD asset, we're adding that amount that you normally would have debited expense and credit allowance to get it to what we thought we were going to collect in the future. Instead, you're going to add that immediately right into the asset itself. Now the portion again associated with market risk, that's the difference between the stated and the market rate. That is considered interest income for the PCD assets, and it's going to be recognized via the effective interest method, which becomes part of the calculation to the discount that's embedded in the purchase price. And that's what we're going to be looking at more in the bond section. The other part is added into the acquisition price, and that's going to be hit as a credit loss. So every year when your asset, you think you're going to collect less, you'll expense more, set up more allowance. So that's basically what we're going to be doing. Now, how do we report this at the end of the year? At year end, we're going to estimate the expected loss and we adjust the allowance accordingly. Again, increasing it, decreasing it, and so on. But when you recover it, remember, you recover and hit the allowance. As far as collateral, Many assets are secured by collateral. If it becomes probable or likely that the financial asset is going to be settled by foreclosing on the collateral, then report the financial asset at either the fair value of the collateral minus the cost to sell. So basically what we're doing is we're adjusting downward, setting up the allowance for credit loss for the difference between the amortized cost and the fair value of the collateral. So basically what we're saying is I secured it, I loaned you money, I secured it with collateral, I think I'm not going to collect it all, so I'll write it down to the value of the collateral. Writing off financial assets, so if the financial asset becomes uncollectible, then what do? We write it off. So basically you just reverse the entry, right? Credit the asset, debit your allowance, write it off. On the financial statement presentations, how is this presented in the statements? Well, the allowance for credit loss is reported separately from the amortized cost of the financial asset. So don't net them. You're going to show the asset, you're going to show the allowance, and then here's kind of what we call the carrying value, the book value, the amortized cost. Off-balance sheet credit risk, that's the guarantor. That, as I said earlier, is reported in the liability section. As far as your income statement, you're going to have their changes in the present value of the financial asset from one year to the next. So it may result from the passage of time, right? So maybe there's a change in the rates or changes in estimates of the timing of the amounts of future cash flows to be received. When credit losses are measured using the discounted cash flow approach, the company can either report the entire change as a credit loss expense or recognize a portion of it that's attributable to this interest versus credit loss expense. If there's changes in the fair value of the collateral, then we're going to report it as a credit loss expense for decreases on the income statement, and then reversal of credit loss expense as an increase in income statement. So if you have a reversal, it's reducing your expense, so it's increasing income. If it's a credit loss expense, expenses reduce your income. As far as disclosures, companies are required to disclose information that will help the users understand the company's methods and relevant information that was used to develop the allowance for credit loss. So that includes about the forecast, the estimated methods, and so on. Because remember over here, what did we say? Over here we said that we're going to estimate the expected credit loss, right? The CECL, current expected credit loss method. But what we're doing is to calculate your percentages, either use historical, current, or reasonable supportable forecast. Well, that needs to be disclosed. We talked about it applies to receivables, financial receivables, and so on. The estimation methods, discounted, loss rate, roll rate, probability, aging, these are all okay methods to use, but this needs to be disclosed in the financial statements. So it makes sense. There's a lot of variables here. There's a lot of judgment that you can use. That's why the new rules say, hey, there's a lot of flexibility here. We want you to be conservative. We want you to hit enough. We don't want you to wait till it's incurred. We want you to forecast in the future so your loss reserves, your allowance are large enough so their carrying value is down low enough so we're not overstating our receivables, because that's what happened in the financial crisis of 2007 and 8 is we had too many receivables, not enough allowance, and companies had a lot of trouble. Some of the other disclosures, the credit risk associated with it, how management monitors the credit quality and assesses the risk. So I have a receivable. How do we check the quality of that receivable and assessing the risk? Qualitative and quantitative aspects of credit quality, disclosures by class of financial receivables. For the estimate of credit losses, how the expected losses are developed, accounting policies for the estimation of the allowance for credit loss, the characteristics of the portfolios, changes in the factors, changes to relevant accounting policies and methods, all the grouping of it, right? What's included in the group of those receivables, reasons for the changes or write-offs, if any, the reversion method applied for periods too distant to enable reasonable and supportable forecasted. So we're trying to go out and say, okay, what are the different judgmental methods we can use? That needs to be disclosed. Significant purchases of financial assets that occurred during the period and amounts of significant sales or reclassifications. You'll see all these disclosures in your notes, but I just kind of want you to understand how it's coming about. Now, what about the changes in the allowance for credit losses? The estimate, right? Debit expense, credit allowance. So what do we have in the allowance? The beginning balance plus current provisions. We're going to add any amounts initially recognized in the allowance for the PCD assets, because remember PCD assets, that allowance amount was added to the asset, so that would be an increase in your allowance. Write-offs during the year, any kind of recoveries, and we'll talk about that in the receivable section, and that should give you the ending balance. So you'll see that kind of makeup in your notes about how we're going from beginning to end, beginning plus current plus any PCDs minus any write-offs plus any recoveries, or minus any recoveries, and then gives you the ending balance. So that's kind of what we're looking at as far as the ending balance. If financial assets with credit deterioration were purchased during the year, what do we have to disclose? So with the PCD assets, that's the purchased credit deteriorated assets. Again, you're buying an asset which has more deterioration than normal. The difference between the par value and their purchase price should be reconciled showing the purchase price, the acquiring entity's assessment supporting the allowance for credit losses, any discount or premium attributable, and that we'll talk about in bonds as far as how to amortize it, any kind of par value that goes along with it. Also disclose information about the financial assets that are collateral dependent or any off-balance sheet exposures, which we mentioned earlier, collateral dependent. If there's collateral and you think you're only going to get the collateral, we have to make an adjustment. Off-balance sheet because you're guaranteeing. Those are the kinds of things that we have to disclose as well. All right, so again, this is a relatively new area, current expected credit loss. It goes hand in hand with things that you've probably studied in school before with bad debt expense for receivables, but now we're going to call it current expected credit loss, or CECL. And again, CECL is forward-looking. It considers the entire lifetime of the loan. It's often using things like discounted cash flows for valuation, but it doesn't have to be discounted. It could be aging, rolling method, percentage of sales, or percentage of some other method. All of these are different methods you can use for valuing it. What are we looking at? We're looking at valuing assets that are held at what? At amortized cost. All right? So again, a lot of meat there. I went pretty quickly, but if you read through it, go through all the different questions, and suddenly it'll make sense. All right? Thanks again. Study hard.